All right. Want to. I'll be one sec.
Hi, and welcome to those who've joined nice and early. We're still 10 minutes before we're meant to start. Just hope everyone is all well and managing in this weather.
All right. Sorry, just checking the dogs are all right.
Afternoon, everyone. Thank you for joining us, those who have joined. It looks like we'll be delayed a little bit because some haven't joined and there's still quite a number to join. If you wouldn't mind holding on till about 5 past, I'll just give you a chance to make some coffee and then we'll start because we just need to give those others a chance, although they are coming in. There might be still there's still actually quite a few to come, so we'll come back to you just before 5 past. Okay, good afternoon. See that quite a number have joined. We said we would start at 5 past. That's in a minute's time. So I'd like to welcome everybody to this afternoon's session with Cheryl Howard. She's a tax consultant. She's joined us many times, and it's always an interesting afternoon. And so I'm going to, without further ado, I'm going to hand you over. And as it's blowing madly outside, I'm prepared to be blown away by you, Cheryl. So go for it.
I'm not quite
Thanks,
sure on that
thanks
one,
very
but
much.
no, it's a pleasure. Hi, good afternoon,
By the
everybody.
way, this morning when I was driving somewhere in my area, one of these municipal dustbins came flying across the road. So anybody driving, you're probably safest listening to this session instead of driving around on the roads. So Cheryl, sorry to interrupt, but the floor is yours.
No hassle at all. I think I was on a meeting earlier this morning. I'm in PE, working from PE at the moment, and somebody said it's not known for the windy city for nothing. So I've never experienced wind like this before. But hi, good afternoon, everybody. When putting this presentation together, especially having a look at the IT 12T for trust, I came to three realizations. The first one is that Fazika, my tax manager, is actually not as slow as I thought she was, because there's a hell of a lot of information that she needs to complete and do. Secondly, that might be overall for a practice. Are we actually charging enough for the work that actually has to be put in? And the third one is that when doing trust, there's essentially three parties of professionals, one being the trustees, one being the and one being the tax practitioner. And the tax practitioner, but before they can actually hit the send button, they've got to have completed the quite a bit of information that either has to come from the trustees or come from the accountant. And I think as a professional body as such, or professional group of people, we are going to need to find that we're going to have to communicate between the trustees, the accountants, and the tax practitioner, and share information just to make our lives easier. I've tried to put in a few practical examples as we've gone along, but it's really just having a look at we're about to hit tax season now as far as the trust is concerned. I know previously, I think it was till the 16th of September, we couldn't download the forms. You can now download the form. I've heard of a few practitioners have actually submitted, but I understand tax filing season for trust starts the 16th of September. And then obviously we've got till the 30th of September to file and submit the IT3T. Now, you can't submit the tax return before the IT3s have been submitted. So let's just have a look. I thought, let me just start at the beginning as to which trusts need to register for tax. Have a look at an overview of the registration process. What were the changes that came into effect in June 2023 that really affected some of our or will affect our 24 reporting as such. Some of it also links with the UBO in connection with the money laundering from a master's perspective. I'm not going to go through the IT3T return in detail at all. I know that there's been a number of communications in connection with that. Then just very quickly looking at the IT3T, the income tax return, and then the financial. I want to touch on the taxing events for trusts, funders, and beneficiaries, because those then link into how, as a tax practitioner, you will then complete the tax return. I've put in the tasks that need to be completed before the return can be downloaded. What is the mandatory information that's got to be uploaded before you can hit the send button? Looking at the form wizard. And again, I've just taken some pertinent information out of that. One particular one where I see that we as a practitioner or as a practice are not when I say complying with, we're not addressing it properly, and it's something I want to look at within our own practice. Look at the deadline dates, and then just I've inserted to give you the links for certain of the SARS web pages, and what the comprehensive guide is here for completing the tax return. So starting off with which trusts need to register at SARS. Basically, every single trust needs to register, whether it's a dormant trust, and as in a bottom drawer trust, or whether it's a non-income producing trust. I know within our practice, years ago, we used to send a letter to SARS to say that we have this trust that's registered. It holds only a residential property. If you want us to register for income tax, please let us know. And as you know, we very seldom got a response, but at least we had a CYA cover ourselves on the basis of, we did ask if we needed to apply. You didn't send us the letter, so we assumed that no registration was applicable. That unfortunately won't cut the grade. Every trust has to be registered for income tax. For passive trusts, in other words, those with either just assets or with limited income, there is a less complex return. And I had a chuckle when I put the less complex together, because tax returns now, I think, can go from 16 pages up to 50-something pages, just depending on how complex it is. So we certainly, as tax practitioners, have our work cut out for us. A question somebody asked me the other day that if the trust receives no income, in other words, all of it is attributed, vested, or distributed, it's got no taxable income, then actually it doesn't need to register. Unfortunately, first and foremost, those types of trusts have got to be registered both for income tax and then obviously the IT3T, because we are now, as practitioners, need to disclose the attributed and the, well, not the attributed, but the vested and the distributed income and complete the document. Very quickly, having a look at the overview of how to register a trust, it's actually quite seamless. And I must be honest, we haven't had too many problems or queries in connection with registering. There's a list of supporting documentation that needs to be added, and the application form, it can either be done online or make an appointment via the branch. So certainly, I want to say kudos to SARS. They are streamlining, and we are getting the work going through quite quickly on that side, or the numbers. Just a quick question. Somebody's, or I've been asked, if a trust doesn't have a bank account, can you still register for income tax? And the answer is yes. I can't answer it as far as completing the RAV forms concerned. Again, we've had one where we've been able to download, where we completed a RAV form without banking details, but we haven't hit the send button yet. But then I want to say, you can't download the tax return without the RAV form being completed. So by default, I want to say that if the trust doesn't have a bank account, you can still A, register, and B, download a tax return. Looking at the changes that came into effect in June 23, again, just all trusts have to be registered at SARS for income tax, and as a consequence are provisional taxpayers. There's additional questions that then expand and open in the form wizard. I want to say, looking through the new one now, the new form on e-filing, I know there's a little block on the right-hand side that instead of having to page down into everything, you can actually just click on the right-hand side, and then you can move to what is the category as such, whether it's the trust information or beneficiary information, or the statement of assets and liabilities, etc. It's actually quite simple or easier to maneuver through the form at the moment. So a nice one, SARS. There's a simplified return for non-income earning trusts where they're only income producing. And the reason for that is, remember that if you've got a trust that holds just property that's not a primary residence, let's say, for instance, a holiday home, remember you've got a Section 7C issue that needs to be addressed then from that point of view. So one of the reasons is why is SARS requiring every trust to be registered? I think twofold. One, on the basis of there's 7Cs or other taxing implications that might come as a result of capitalizing or setting up the trust. And then obviously the other one is they actually just want to get their arms around these trusts. I think figures have been bandied of about 300,000 trusts that still aren't registered. So it's kind of twofold. One, there are tax implications, and the other is just to get the arms around how many trusts are actually out there. The other change is reporting of distributions from other trusts. A big one is capital gain. That's often I see slipped in the form of if you've got a trust, one trust that's a beneficiary of another, and we're all aware that trusts have got the conduit principle, that the whatever flows in on the one side, that's then distributed out to beneficiaries on the other side in the same year of assessment retains its identity. So if you've got rental income coming in, rental income goes out, interest to interest, etc. Except that for capital gain, if a capital gain is distributed by one trust to a second trust, and then that second trust onward distributes to its individual beneficiaries, that second trust is in fact taxed on the gain. You can't pass the conduit principle through to a third one and then have it taxed in the hands of the individual beneficiaries. And then there could also be a Section 7 attribution rules if the trust has been capitalized by funding from another trust. Then dealing quickly with the IT3T return. This is the new third-party declaration that all trusts have to be, where you're distributing or vesting income to beneficiaries. That's got to be submitted by the 30th of September. And it's disclosing your beneficiary income going back to the end of February. And note that you can't submit your IT12 until such time as these IT3 returns have been submitted. There's quite a bit of information that's required. It's the submitting entity, a reporting entity, donor entity, reporting institution, details of a person, a beneficiary, which is could either be a trust, an individual, or a company. Then confirmation of the taxable and non-taxable amounts distributed or vested, and trust financial flows. There's, again, quite a good user guide with regards to the completion of these returns. I know we're still struggling a little bit with downloading if you've got extensive documents that you've got to do via the SARS support software. We're still grappling or still dealing with a little bit of that at the moment. What I have raised, though, is that there is a mismatch between the IT3T, the income tax return, and the financial. I know sitting on a SARS committee years ago when they were moving from the good old big purple A3 page tax returns and the manual tax returns to e-filing, one of the issues that was raised was specifically the attributions and how to account for it. My view was when SARS disbanded that 3-page or that A3 size tax return, they actually lost control over what they were, who they needed to tax in the form of the individual beneficiaries, because it was a really good long schedule that had all the columns, and you basically started with interest received and you went all the way down to other income with a total. and then the columns down, it started with received by and accrued to the trust, minus direct expenses, minus indirect expenses, and then it went to attributed, vested, and distributed, and then income then taxed in the hands of the trust. When that went into e-filing, everybody still talks about vesting and distributions, and you see it again in the form of the IT3. I mean, the IT3T, but you don't actually never ask about the attribution. And when one comes to do the tax return for a trust, attribution actually is the first thing that you've got to deal with. So the question is, where is that actually recorded and dealt with? Because in your income tax return, it's one globular figure. Then you give the details in connection with your distributions and vestings. Your IT3T deals with distributions and vestings, but somehow the funder or founder, the settlor, and when I use founder, settlor, or donor of the trust, it's the people that are actually capitalizing the trust, not the person who formed the trust. Because remember, in your attribution rules, it's your funder or donor, the person who put the money in, who's the one that's then got the attribution, not the person who settled the trust. Also, then the IT3Ts won't necessarily reconcile to the tax return because the tax return's got your attribution where your IT3s don't have it. And then the other one is the financial statements technically don't reflect just the attributions. So again, where is this information recorded, and how's the donor aware of what to include in his or her return of income? You'll see in the paperwork here, I've included a ratifying resolution that we use for our trust. Somebody said, oh, but you're giving away information here. And my view is the more of us who actually in the trust scenario, such whether we wear a hat on as a trustee, as the accountant, or as the tax practitioner, the more of us who can actually streamline and give that information, I think it's for the better of the industry as a whole. So you'll see I've included it. I'll go through the document with you. That is just our practice document that we've used over the last probably, I want to say 4 or 5 years now in the form of information. And we're finding that our queries are minimized by giving this amount of information. My view always is you give as much information as possible to staff to answer their questions so that they, you're not going back and forth with query, because wearing your hat on as a business person, going back and forth, you're obviously losing time. I would appreciate that anybody who's having a look at the ratifying resolution and has got comments to make, please, I would. It's a working document as such, and I would love some feedback and look at streamlining and improving it as we go along. And in that ratifying resolution, I'm then trying to deal with the attribution, the vesting, the distribution, and then any other information that we may or may not need now as tax practitioners to complete the return of income. We recently had a sign-off for a trust about a week ago, and we don't do the income tax return for one of the beneficiaries, but obviously completing the returns now, we need their tax number, we need their contact details. And as trustees, or with a hat on as trustees, we debated whether, as an addendum to the set of financial statements, whether you actually put that information in to say this is the per beneficiary, this is their tax number, contact details, email address, etc. One of the questions was just in connection with the PUPI Act, have we got an issue? And then the other one is that's actually a hell of a lot of personal information that if you take into account what you've got to put into the tax return, there's a lot of personal information circulating. So the agreement we're going to do, or the discussion was, we're going to do almost an annexure to our ratifying resolution, because in the UBO that's required for the master's office, they ask for all of the information like ID, email address, contact, telephone number, and details, etc., but they don't have tax number. But then when you go to complete your tax return and the IT3T, you need the tax number. So maybe it's then just a case of taking the two lots of information, meshing them together. So for the tax practitioner, they've got one set of documents with all of the details, and then put as much information in the financial statements as possible, so that whoever's completing the tax return can then plug in and pick up that information either in the ratifying resolution or the financial statement. I think the whole idea here at this stage is to make life easy with a minimal amount of queries, and the fact that we're on a constant seek and find for information. Let's get that information at hand, in that most of it will actually just roll over from year to year unless there's any changes to addresses or cell phone numbers and email addresses. Looking then at the events from the taxing events for trust, the funders and the beneficiaries. And as I say, the funder is the person who capitalizes the trust and puts the money in. Essentially, the trust is the taxpayer of last resort. First, it's the funder for attributed income on the value of the loan or the benefit to the trust of giving a soft or interest-free loan to the trustees. The second then is income that's being distributed to beneficiaries. The third one is vested income. Remember then, invested income, it doesn't necessarily need to have been paid out. It can then be put into on loan account. And then lastly, what's ever left over is taxed in the hands of the trust. What's important is that this vesting, this third portion here, the trustees would need to have exercised their discretion by the end of the tax year in awarding the vestings. Most distributions may or may not have been physically executed during the year. If they haven't, and you are going to make a distribution before the end of the financial year of the trust, then again, that decision needs to be made before the end of February and recorded in a resolution. Then with regards to from 2025, all distributions and vettings of income and capital gains to a foreign residential beneficiary will be taxed in the hands of the trust. Previously, only capital gains that were vested or distributed to a beneficiary were taxed in the trust. Now going forward, any income that is vested or distributed to non-residents will be taxed in the hands of the trust. This, folks, is becoming more and more relevant with more and more of our clients who've got kids who have gone overseas and who are in the process of actually completing their RAV-1 forms and changing their residency. And I know a number of clients or number of kids are changing their residency, because they're not sure if they're going to come back from a South African point of view. But remember, if you don't change it, whatever your earnings are that you've earned offshore over the, 1.5 million, may be taxed in South Africa. So have a look at that in the form of, this is not really trust related, but have a look at that in the form of beneficiaries. If they are changing the RAV format, they are becoming non-resident, not necessarily South African resident temporarily abroad. They've literally ticked the box to say non-resident as such. Any distributions and or vestings going in from 2025, these will then be taxed in the hands of the trust. So again, tax practitioners, the onus or the responsibility is on, I would imagine, you folks to go back to let the trustees and or the accountants know that actually we need to, or they need to be aware of that. Then having a look, the third or fourth section, rather than for the taxing events for the trust, is the section 7C, which is the deemed donation on the softer interest-bearing loan. So a funder can both have attributed income as a consequence of giving soft loan funding to a trust, as well as the 7C deemed donation on that soft loan. And just remember that the attributions taxed in the funder's return of income, again based on the conduit principle, where 7C is taxed as a deemed donation and reported in the IT 144, which is then payable by the end of March. I just want to pause here quickly before we go. I see there's a whole lot of questions that let me look at these then quickly and answer some of them before we move to the next section. Just says whether IT 12 does not declare capital injections into trust, where in the George, I'm not. If I can have a look at that one and then come back to you, there should actually be, it would be a capital award or trust capital distribution then from that point of view. I haven't got the form in front of me. I've just gone for a blank, but I think it would be a capital. It's a capital distribution to the trust. There's got to be a point mark for it. Let me come back to you and have a look at that. I've made a note of that, and then at tea time we can just I'll go online and just have a look quickly. Then I noticed the IT3 can be requested on a monthly basis on the SARS via drop down. Does this mean a return filed on a monthly basis, or can the return be filed annually? I understood it's only filed annually. I think the reason for it maybe monthly on a drop-down box would, let's say, for instance, if you've got a beneficiary who's died and then you've got a deceased estate, or also a beneficiary who's immigrating and you've got to then do the income tax return to the day before immigration and then do the calculation. I would imagine that is the reason for doing the IT3T in assisting beneficiaries with half pro rata tax years, but for the main, it's the end of the year. I thought all trusts must have a bank account. You know what, Chantal? You're actually right in connection with that. That in terms of the Trust Property Control Act, every trust has to have a bank account, but there's a problem with regards to a trust that's only got, let's say, for instance, a holiday home, and in terms of the trust deed, all the beneficiaries pay, or the beneficiary using the holiday home settles that. There's two things. One, you've got a hell of a lot of bank charges, so accepting the donation gets eaten up with probably in about a month or two, if not for bank charges. And then the second thing is, if that bank account is not active, it actually is then you've got an issue at the bank, they deactivate it again. So what we do, and I understand I'm an accountant, sometimes trying to play lawyer, what we do from a trust perspective is draft a resolution. We're not contracting outside of the law. The law says that a trust should have a bank account. We then say, we draft a resolution as the trustee to say we acknowledge we should be doing it, but because of the cost and because of the fact that it's not going to be actively managed as such, and we would then have to restate or provide the FICA with a trust. We haven't got a bank account. We agree that the donation is accepted and held in cash by one of the trustees as such. Usually that is used to offset maybe setup fees. And when there is income, a bank account will be opened. So I know it's not correct in the letter of the law from a legal perspective, because the Trust Property Control Act says there must be a bank account, but it's maybe one way of managing it. So the submitting entity, it's correct, George. It is the person who's responsible, the main trustee. Then, from that point of view, I can't answer the number because we're also jiggling with that. I actually understood the numbers to be generated by the system, but it doesn't appear to be. So again, I'm not sure if you just manage and run your own numbering system. George, I'm going to ask if we can just hang on with the reporting institution, the tax number for trust name, address, tax number. The answer to that is the reporting institution is the submitting institution, and that it would be the same information then on that side. It's not the reporting institution as in the financial institution. So yes, it is that same information. If the trust does not make any distributions, do you have to still submit the IT3? The answer is no, because then, Alan, remember, everything is just going to be taxed in the hands of the trust. So you won't have the IT3. And then, sorry, Mohammed, sound is crackling. I hope it's not too bad now at the moment, and that we've answered some of the questions. I hear it's difficult speaking. I'm not sure. Sorry, I'm sitting close. I hope the echo, Barbara, sorted. So that's then in connection with all trusts have to be registered. Then how to register the trust, as I say, can now be done online. Obviously, there's a whole lot of documentation that needs to be submitted. And the documentation requirements are dependent on the type of trust, whether you've got an A or a B trust, being your special trust, or whether it's an inter vivos trust or testamentary trust. I know there's also the employee benefit, etc. So each trust has got a list of information that's required. We then said that in order to, I just want to quickly go back, in order to register the trust, I've done that, we've dealt with the changes, which really have got a lot to do with more just disclosure, and I'll go through that with you. We've got the 3 events as far as the fund efficient, and then the trust for any undistributed or vested income, unless that vested or distributed income is going to a non-resident for capital gains for 2024, non-resident for income and capital for non-residents for 2025. So now having a look at the task to be completed before downloading the income tax return. When you call up the return as such, it starts off to say, have the banking contact details and trustee details been verified? If you say no, it automatically goes then into, it pre-populates, and you essentially almost get the RAV information, and then you follow the process of how you would ordinarily verify and submit the documentation. If you say yes, then it comes up with a whole wizard system, which you then go down case by case and complete. And then let's just quickly have a look at the no. The information that they need here is the contact details, the address and the bank account. As I say, we've managed to update a document without a bank account, and on that updated document, we've then been able to receive or download the IT12. So I am surmising that it's fine that you can submit without a bank account. Then in connection with this public officer, representative, taxpayer, and trustee. Looking first at the representative taxpayer. As a representative taxpayer, that person is literally the person that is on the hook for paying any taxes, or is basically responsible for the submission of tax returns and any unpaid taxes within the trust. So as a tax practitioner, I want to say, I certainly don't want to be responsible for paying any of my clients' taxes. So just be careful as tax practitioner and or as the independent trustee that you're not taking on the responsibility then as the representative taxpayer. You have the public officer and the main trustee. That public officer is essentially, there's no such in your inter vivos trust, it's your main trustee as such. And that main trustee is then literally the person who probably 9 times out of 10 could be the representative taxpayer as well, is often the client or the check writer in the process that we call. And then the person then responsible for reporting the information. I've given you an example of what we've prepared for our for the trust, where we need to load up the information, and this is where we basically say that we appoint Joe Bloggs to act as the representative taxpayer public officer. Since doing this, it could either be public officer stroke main trustee, because I think main trustee is used quite frequently in some other documentation. So it's the representative taxpayer and or public officer main trustee for tax purposes on behalf of the trust, and it will then remain in force until the trustees decide otherwise. It's just information that's required then with the RAV form. Now, once you've gone through the RAV form stage, you've verified all the supporting information. It's you going to complete or compile the tax return. Before you can submit the tax return, you actually need the following information. One is the annual financial statement or the annual administrator's account. Your administrator's account might be in trust where there's curatorships or special trust. Remember the Trust Property Control Act, it actually just says that you've got to keep record of account. And there is no IFRS for SMEs, or there's no standard in the form of a set of financial statements that, or the format for annual financial statements. I know most accountants use IFRS for SMEs, and then that it just needs to be tweaked in that, remember, you won't have what do you call it, share capital. Your share capital is actually your trust capital, and there may or may not be some adjustments that need to be made to trust capital and or the retained income if one's keeping schedule in that in your trust. If you've got capital beneficiaries and income beneficiaries, you might need to then just expand that. Again, I've been asked on the basis of what do you do if you've got a passive trust? In our instance, we complete IFRS set of annual financial statements for all trusts regardless. It just makes our system a lot easier. It looks professional if you've got a standard document that goes out, that's got all the requirements in the form of, be it the cash flow statement, be it the your notes, your reporting, etc. It just makes it look professional. And certainly from a SARS perspective, if they get a set of financial statements styled on IFRS, I'm hoping and touch with the chances of queries are far less. Then the other documents that need to be loaded is the minutes and the resolutions of the trustees. And it's all documents other than those dealing with internal governance and or administrative matters. So in my mind, I would think that administrative matters and internal governance is where Joe Bloggs has been given permission to manage the bank account and or sign off on investment instructions, or paying of beneficiary amounts, etc. Depending on the amount of activity that you have in you have within the trust, that could be quite a lot of information if it's your minutes and resolution. For me, there's two main documents. One is, I want to say, the ratifying resolution of the trustees, and I'll show you what we've got in our ratifying resolution. And then the other one is that resolution where the trustees have exercised their discretion and vested and or distributed the income by the end of the financial year to the beneficiaries. For me, those are the two important documents that SARS essentially need or want with regards to assessing the return of income for trust. Then they want a copy of the trust deed or the will. If you've had replacement trust deed, you don't necessarily need to submit all of the previous documents. You can use the replacement trust deed. What we have done is then included a copy of the letter from the master where they've accepted our replacement deed. Obviously for testamentary trust, it's the will. Then SARS required the beneficial ownership document per entity listed, and that per entity listed will be for the trustees, the founder, the named beneficiaries, or any person who's received any benefit. SARS need a copy of the letters of authority, and where applicable, proof of any tax credit. Just remember, there has been some changes with regards to tax credits now. So this, from a set of financial statements, I want to show you what we're including on our general information page. And this I'm wearing with my hat on as the accountant, because again, this information is available for the tax practitioner when they need to complete the information. So are the financial statements overkill? The answer is probably yes, definitely. Is it making the lives of our accounting and especially the tax team easier in completing the returns? I do want to say yes from that point of view, because the information that they actually need is then in one set of documents that they will need those set of documents anyhow when they've got to submit the tax return. So the first one is the country of incorporation and the domicile. Remember, you can have a trust that was actually incorporated outside of South Africa, but as a consequence of it being managed in South Africa, it's then a South African trust. So we would then put in the details of the country of incorporation, the type of trust, whether it's an inter vivas testamentary. We do actually now just say passive or investment holding or trading, and I'm trying to actually just expand that based on the information that we need to complete on the tax wizard. Objectives of the trust is fairly standard. It's that paragraph that most trusts have at the bottom of the start of the trustee to say that the trust is created for the benefit of the beneficiaries as such, for their ongoing maintenance, etc. And again, I'm talking to folks on the basis of probably our trust, what I'm talking to is mainly all inter vivas family trust. So that's the objective. Put on the trust number, put on the income tax number, make a note of the founder's name. If the founder's deceased, put in that it's deceased and the date deceased, details of the trustees, then details of the beneficiaries. It's a little bit of a tricky one on the basis of previously this detail of the beneficiaries was the extract of the definition of or the defined beneficiaries in terms of the trustee. Now, from an income tax perspective, you only need the beneficiaries who've received benefit during that year within the income tax. If you've got a named beneficiary who hasn't received any benefit, you're not making any details within your trust tax return, unless obviously that person has capitalized or funded the trust. But if you've got the kids down and no distributions have been made to the kids, you're not really reflecting that kid's information. The beneficiaries, if they name beneficiaries, will be on the UBO form. So what we've decided here is we're still going to stick with our beneficiaries being the definition of beneficiary. And then in our notes to our financial statements, we would then make details of who's actually physically received any benefit, because that will be required in terms of the movement in the income statement and all the income statement in the form of distributions and or vested and or distributed capital on the balance sheet. And then in our ratifying resolution, we will give the information of the beneficiaries who've received benefit in that the year of assessment as such. We've got the business address. Again, it's needed. We've had the UBO, and then where that register is maintained. Remember, you've got to maintain. You've got to have the register where it's maintained, and then we put in when it's been submitted on the master's portal, just so that there's again a double tick or a cross that the information has been actioned and done. We put in the detail as to who the individual main trustee is and if there's a representative taxpayer. So again, we're trying to give the tax practitioner in our set of financial statements as much information as possible to allow him or her to complete the returns. Now I want to talk you through our ratifying resolution, which is part of the documents that have got to go in that are mandatory before you can then submit the return. Now, as I said, this is our document that we've expanded and worked on. It's not by no means complete. When I say complete, it might not necessarily cover all aspects as such, and it's actually it needs to be a bespoke document depending on the circumstances of each trust. Right at the end of the set of slides, I've actually given you the details so you can see how we've completed it. And in fact, I want to say it's probably worth just quickly going through it. It's probably easier just talking it through to have a look at the information. So the first one in our ratifying resolution, we start off to say that this is for the financial year ended 2024, that the financials have been tabled, accepted, and approved by the trustees and are signed accordingly. If we've only got one trustee signing on behalf of all the trustees, then you would put that person's name in this document. Otherwise, in most instances, we always get our trustees to sign all the trustees to sign the financials. Then we obviously detailed the return of income for the financial year, and that has been approved, and that so-and-so is authorized to sign it on behalf of the trustees. And that so-and-so being Joe Bloggs might be then the main trustee, and the keys then referenced back to our financial statements. And then whoever the accountant and or tax practitioner, here the accountant and tax practitioner are one and the same. You might have a split in that you might have accounting done by an accounting firm and the tax done by somebody else. You might want to then just split that out, but you put in to say who's the representative for the accountant, and likewise with the tax practitioner, and that he or she can attend to the administration. Then we deal with this trust statutory and financial information. We state where the trustee is registered, which office, because again, remember, the tax practitioner needs to check that. Most times it's pre-populated, because when you register the trustee state at which court the trustee is registered, it's just a check. If there's been any amendments to the letters of authority, then again, it's in this document. So when the tax practitioner is going through it, it's an automatically trigger for him or her to say, okay, there have been changes, I can then mark accordingly. And then what we do is actually detail who are the current trustees and provide their ID numbers. then, as I say, the question was, and we were sitting having a look, do you actually put in the tax numbers for the trustees and contact details? My view is no. Keep your document simple as far as the ratifying resolution is concerned, and include information that is ordinarily available. So, for instance, in your letters of authority, the full name and the ID number of your trustee are reflected, and therefore it's in the document. You're not giving other information out. Then we say who's authorized as the accountant to maintain the records of account, the UBO register, compile, prepare, etc., and attend to the administrative documents. We confirm the tax number, and then we confirm the business, postal and physical address of the trust. Again, the tax practitioner needs that. Then, with regards to the ultimate beneficiary owner, we confirm, again, who is the person who's authorized to sign the documentation on behalf of the trust as required by the Trust Property Control Act, as well as who the main representative, that person may be the main representative at SARS for income tax purposes. So again, we just providing that information as to who is that main trustee, if it's the one and the same or different people as far as managing the UBO. And then we confirm that it's been submitted and uploaded to the master's portal on the date. Now, this for me is probably an administrative matter that if you go back to what information SARS does or doesn't require in the uploading, technically I would say this doesn't need to be uploaded. But given what I want to show you, that what our ultimate objective is, and this document, your ratifying resolution for an ordinary trust where you've kind of got mum, pop, kids, 3 trustees, and maybe property and investments, investment portfolio as such, you probably find that this document, once you've completed it, is probably about 4 pages. So I would, for us, we included, does SARS need it? The answer is no. It's in this information because it's our year-end ratifying resolution, and I'm wearing my hat on as a trustee. Technically, then you need to ratify that information, because remember, you should actually just give the trustee authority from time to time, or from year to year, or until such time as something's changed. So I do include in our document here who the wealth managers are. If there's a money market account and or a bank account, I do put in information. I do put in that what is the nature of the portfolio as such, and that who's authorized to give instruction and sign any documentation. Then here we say, again, sorry, here's who's authorized to give instructions, sign the documentation, that this authority remains in force, amended by the trustees in a resolution. And then add to say that the trustees ratify and review all the portfolio-related transactions, including any withdrawals to any beneficiaries, and ratify them to the end of February. Just remember, though, this isn't overriding the decision that's been made at the end of February with regards to your vestings and distribution. Then we itemize the assets and investments as such. What is the property that's owned, when it was purchased, and if it's been used by somebody. I do put in some instances that if it's being used specifically by a beneficiary, that beneficiary is not paying rent in terms of clause XYZ of the trust deed, but in lieu of not paying rent, they're paying all the running costs of the property, or that the trust is paying the running cost of the property. CapEx costs you always want your trust to pay, because then remember you've got your, or when I say the trust to pay, you always want, it might be funded by a funder as such, but you do want to account for it and include it in your trust financials because of the capital gain and the base cost for capital gains tax purposes. We detail what investments are held and where the bank account. So add to as much of it as you want to, or take away from it, depending on the kind of circumstances. Now in here, we do the distribution to beneficiaries. And in this, we would then say the following distributions have been made to the following person. Now we are including the full name, his ID number, and his tax number. So again, for the tax practitioner completing the form, all that information is readily available. In this instance, we've said it's foreign dividends and a local capital gain, and that Joe Bloggs then reflects the distributions in his personal return of income. And in this instance, the trust settles the tax due on these distributions. What I haven't put in here quickly, I just want to tell you then, on the basis of the distributions to beneficiaries, these might be the vested and or the distributed amounts. And then we do exactly the same in connection with our attributions, so that at least somewhere along the line, if the minutes are being, or this resolution has been circulated to the beneficiaries, that information is available as to which are the funders, what do they have to include in their individual tax returns. As I say, it's a document that we have put together, trying to cover as much information as possible. What I also want to tell you that we've done in connection with this ratifying resolution is that if we've got and issued other resolutions during the year, be it for, let's say, failing trustees, appointment of subsequent beneficiaries, purchase of properties, etc., right at the end of our ratifying resolution, we then put in a summary almost of the resolutions that have been issued during the year, put in the date it was, the period it was approved, and then what the nature of it was, so that if from a SARS perspective, they need to see, and I'm trying to think what they would specifically want out of looking at the purchase of properties as such with regards to the resolution, it's actually itemized in there. So this ratifying resolution is essentially almost a summary of what happened in the financial statements, and extracting and unpacking that information in the financial statements that can answer the tax practitioner's information. Plus, then it's a summary of the trustees' administrative matters that they've dealt with during the year. So it's one document with everything in it, and therefore your tax practitioner's loading up maybe 3 or 4 pages as opposed to a whole lot of individual resolutions. As I say, the test case will come once we actually submit, but certainly in the past where we've had audits from from SARS where they've asked for resolutions, etc., we have in fact submitted this ratifying resolution and had very little comeback from that point of view. So again, starting at the top, we deal with the financial year end, who's responsible, who's signing, just the information on the statutory and financial, the UBO, who's administering the accounts, details of the assets and investments. Then the distribution to beneficiaries, I've said here, maybe reference this to the IT numbers, purely on the basis that if you were then putting in Joe Bloggs, he received interest, and whether it's then in a tabular, if you've got a number of beneficiaries and a number of income streams, then you might find it's easier in a table format. And then one of the tables might then be the IT3 numbers, because it then picks up, it's then easy just to reference. Then we also confirmed the loan to the trust, saying that the trust is indebted to the following funders or donors as such, whether the loans are interest bearing and what are the terms of repayment. And in this document, as well as our financial statements, we actually identify which loans are subject to 7C and which aren't. I know from a recording point of view, if you've got Joe Bloggs as such, and he's put in 20 million, of which 5 million is for the funding of a primary residence, that's carved out in terms of 7C, and then obviously the 15 million is subject to your 7C deemed donation. On your documentation, from a SARS perspective, you really just put in the one figure, but if the assessor or somebody is having a look at the information and they see that the IT3, if they call up and reconcile the IT3T to the IT144 with a donation, at least that information is there to say what is subject to 7C, what's not subject to 7C, and whatever we've taken in the form of attribution. And then lastly, this is what I alluded to, where we say we do a list of the trustees' resolutions approved during the year under review and maybe or to the date of this resolution. And then we do a list or extract of those resolutions or the minutes, just to limit the uploads to SARS, but just make sure that at all times there's been full disclosure. Then other information that's required that needs to be uploaded, they want beneficial ownerships. It's an organogram essentially showing effective control of the trust, where ownership is in the form of other legal arrangements, like for instance a partnership or a company who's the trustee. It's the Excel spreadsheet. Again, just use the document that's prepared for loading up onto the master's portal. You've got a maximum of 20 people that may be, or 20 lines, I think, that may be uploaded. Somebody asked the question that if you load in the Excel spreadsheet, have we got a problem that can then be manipulated or changed? I would figure, as much as everybody's seen all the spam and the scamming that's happening and going through, probably the problem is all that information is out there. And then, and as I say, that Excel spreadsheet, it's a good document that the tax practitioner needs in order to complete the tax return, but it doesn't have the tax numbers on it. So again, and I wouldn't want to put the tax number on it. Well, you can't put the tax number onto the document that gets uploaded to the master's portal. So maybe you've got an Excel spreadsheet with multiple tabs, depending on who's using it or for what purposes it is. And then in terms of the beneficial ownership, SARS is also looking for any other information that expands on control and ownership. Now, remember, with the UBO, they use the word person who exerts control over a trust as such, so trust assets. So you might have, let's say, for instance, your independent trustee, that person's in as a on a UBO as in a trustee capacity, but in one or two instances, we've got specialized property, and we have, let's say, for instance, the game farm and or the boutique hotel managed specifically by somebody, and that might be a major chunk of the asset. We have actually brought that individual in because that person is exercising control over a large portion of the trust assets. They're not a beneficiary, they're not a funder, and they're not a trustee. So it does ask for information from that point of view. Ownership literally is either your, I'm interpreting it as being your distributions and or your vesting. In order to have your vesting carved out of Section C, 7C, the trustees still retain control over that distribution as such, or that amount that's due, as to when it will be paid and how it's going to be paid as such. But just remember that if your beneficiary dies, or in the event of divorce and or sequestration, that loan account is actually included in the beneficiary's statement of value of assets from that perspective. So just before we go in and have a look at the wizard as such, I just want to see if there's any questions or if there's anything that we need to add with regards to this section then quickly. Rose, you've said no ITs need to be done. I was under the impression you still had to do nil. Again, can I come back to you on that one? I must be honest, I thought that if there was no income to distribute, you weren't going to do anything with your ITs, because remember, the information that they're looking for is actually in your individual returns if need be. And then how do you handle the annual 100,000 donation to reduce the loan account where cash is not actually paid over to the trust? So a while back, you couldn't do that because then you had a problem in that there was, if you forgot what's it, forgotten or forwent or forfeited the it's not forfeited, if you forgave the 100,000 of the loan account in lieu of donation, that was deemed as a CGT event. So then what was happening, the trustees were paying the 100,000 at the end of the year, and then the funder was then paying it back as a donation to reduce. Then that changed, and you could again go back to doing book entries. So on our side, we do it as a book entry. We actually do the IT3, the IT 144 for it and just record it. Most times SARS send it back in that you don't need to submit it, but again, we've got a record. Again, that will be put in on our information sheet as such, or our ratifying resolution to say that we've accepted the donation. But just, Alan, be hella very careful that you're not using your 100,000 donation for losing your capital amount, and then you've got to pay the donations tax on your Section 7C. Because remember, your tax, your deemed donation, you do your loan account, it's done on a monthly basis, simple interest, done at, I think it's your table 3, being your repo rate plus 100 basis points as such. And it's calculated monthly, simple, not compound, get to a figure. That interest, you then deduct 100,000 Rand of that interest, and whatever's left after is then multiplied by 20%, being your donations tax. So if you're using your 100,000 for your Section 7C to reduce the amount of donations tax you pay, you can't use this 100,000 by forgiving a portion of the loan account. You can, if let's say, for instance, your interest comes to 70,000, then you shield 70,000 with the 100,000, and then you can still donate in lieu of loan account the other 100,000. Then in that instance, on our IT 144, we would still show the full 100,000, but you would show the amount in terms of your 7C, and then you would show the amount in terms of your forgiving or in lieu of loan account. That's the words we use, in lieu of loan account. George, I just want to then have a look. How do you handle income earned just for IT3B document, not reconciling with actual income earned as per financial statements? Income was not available for distribution. George, do you not need to then, income was not, I want to say I'm not 100% understanding your question. If you've got, it should either be on your income side, it's the earlier of your receipt or accrual. So if, let's say, for instance, you've got an accrual, and 9 times out of 10, I want to say they're actually included in your IT3B. So let's say, for instance, on your investment or your bank account, you've got an amount that's earned and or accrued by the trust of 100,000. Then if you say the income is not available for distribution to the beneficiary at year end, because it's an accrual, remember, you can still vest it without paying it over. If that's, tell me, give me I don't know how you get thumbs up. I see there's a whole lot on here, but if I'm now, as I'm talking through your question, if it's a case of you've received 90,000 that's physically in the bank account, 10,000 that's been accrued, not yet received by the trust, and then come the end of the year, you want to vest that monies, you're going to vest the full 100,000, because remember, you're vesting then, because you haven't got it in from a trustee point of view, you can't pay it out to your beneficiary. You can vest it to your beneficiary on loan account. That specific vesting on loan account, provided only gets paid at the discretion of the trustees, is then carved out for 7C. And from a trust perspective, all of your taxable income, you've then been able to distribute to your beneficiaries. So if I'm understanding your question, you work on earlier receipt or accrual in your financial statements, and then your outflows is on physical payments or an accrued indebtedness that you owe your beneficiary. Les, where can we find the sample of ratifying resolution? Les, I've added one at the back of all the documents. That's what we looked at. As I say, it's our internal document. If you want to drop me a line, I'll blank out all the names and all that jazz and send you a comprehensive one that you can then use as you want to. But it's not a public document as such. It's our practices internal one, but very happy to share, no problem at all. Please define precisely who is the UBO, the beneficiary or the trustees. George, it's all of the above. The beneficiaries, if they are named in terms of the trustee, or if they've received any benefit from the trust. So a while ago, and I want to say long before UBO even came out, it actually had to do with all KYC when opening bank accounts. Sorry, just give me one second. Because when all the KYC came in, you had to give all the flipping information of beneficiaries, even if the persons hadn't received benefit. So years ago, we actually changed a number of our trustees to say the beneficiaries are Joe Bloggs, the spouse of Joe Bloggs, and most instances we actually put the name in because I know there's been a question as to whether the spouse of Joe Bloggs is the spouse when the trustee was signed, or wife number 4 when Joe finally pops the perch. And then instead of putting individual children's names, oh, sorry, folks, sorry, my apologies. Instead of putting the children's names, we would then put the descendants of Joe Bloggs and their remoter or their descendants, etc. So if we haven't paid out any money to any of those descendants, any of little Joe Bloggs and Sally Bloggs Jr., etc., then, George, for your UBO, you don't need to disclose them if it just says descendant. You only need to show the beneficiary or named beneficiaries or people who've received benefit. So let's say, coming back to my example, your beneficiaries are Joe Bloggs, Sally Bloggs, and the descendants of Joe and Sally Bloggs. And then in this year, you actually physically pay money out to little Joe Jr., then your UBO for your for the master's office, as well as your reporting here, would essentially be Joe, Sally, and Joe Jr. Then from a trustee perspective, you've got to give the details of Joe and Sally, assuming mom and pop are the trustees, plus the independent trustee. So then you're giving Joe with his hat on and Sally with her hat on as trustees, and then the independent trustee. And then remember, you've also got to give the name of the founder. So if Joe was the founder of the trust or the settler, as in Joe Bloggs's uncle, then you're also giving Joe's information. And if Joe's died, you still have to advise that Joe has died. So your UBO information is how long is a piece of string. It's how many people have either received benefit, exercise control over the assets, directly or indirectly, the trustees, and the settlor. It's not the funders in this instance, it's the settlor. The OCA actually said, I hereby create the trust. Where do we find all the information to be certain in the resolutions? Les, you've got to talk to your trustees. That's actually a trustee, it's a trustee matter as such. So it depends on which hat you're wearing on, but essentially that is your trustees will complete that information. George, as I've said, I don't know how that number is formulated. That I've got it in. We still don't know how those numbers are pre-populated or generated on the IT3T. I can't help you there. Then what is the size limit? Lauren, there is a size limit. I want to say it's 3 gigabytes or megabytes, but yeah, there is a size limit, and I think it's almost, I'm assuming this is for the uploading of the information in the return. And yes, it's probably what your normal information is with regards to uploading of documents. Please clarify what beneficiaries are. Okay, Luke, I'm assuming that you are referring it to in the UBO, and I hope I'm answering George's question with regard to who beneficiaries are then you've identified for your tax return. It's the beneficiaries who've received benefit in this particular year of assessment. So let's go back to my example. In 2023, Joe Bloggs and Sally Bloggs favored little Joe Jr., and Joe Jr. passed matric, and he was given a distribution as such, an income distribution. So for 2023, Joe Bloggs Jr. would then be reflected as your beneficiary, and you would have his details in it. Now in 2024, Sally Bloggs Sally Bloggs Jr., or I don't know, she's now matriculated, and they've now given her some money, and she now needs to disclose that income because it was interest in terms of the conjure principle. She needs to disclose that as interest in her tax return. In the 2024 tax return, you're still bringing in Joe Bloggs, Sally Bloggs, and then Sally Bloggs Jr. 2023, you had Joe, Sally, and Joe Jr. The fact that Joe Jr. received something in 23, but not again in 24, you don't report him then in 24. The income stays in the trust, no income distributed. The income stays in the trust, no income distributed to beneficiaries. There was income in the trust. So in this instance, Rose, then you're right, then the trust is then taxed on it at a flat rate of 45%. Oh, I'm so sorry with the cough. just more information in connection with my question. Rose, where to confirm if you had no distributions done, so no RT3s need to be done. I was under the impression that you still do null RT3 returns, and you're saying that everything was retained in the trust. Rose, I understood if it's all retained in the trust, there is no RT3T. Because remember, your RT3 document is to pre-populate the tax returns so a beneficiary doesn't miss income not disclosed to him or distributed to him. Because remember, often you find that the trust is administered by mom and dad and their trustees, and then they distribute income to either their grandchildren or their adult children. And their adult children has another tax practitioner to do their personal tax return. The kids, the grandchildren, the kids, they need some sort of document to be able to say to their practitioner, I've received interest of this, foreign dividends of this, tax-free dividends of that, and rental income of that. That's what this whole idea of the IT3T is, so that SARS know who else is receiving income, and it's then technically, ultimately, it will get to a stage, like for instance, with the banks and the medical aids, etc., where that information is pre-populated. As I say, I'm under correction, but I understood that if at the end of the day, there's no distribution to a beneficiary, there is no IT3T. I have made a note of that, and via Stan and or Danny, we can then just confirm that. Yes, therefore, no tax complications in the trust. Okay. Beneficiary in this case, then you're to the
hold on, Cheryl.
might...
You're losing sound.
Am I there? Am I okay? Am I back?
It's still a bit. Let's try again.
Sorry, I tried that. You all didn't get the cough and the splatter. I really apologize. I hope that's better. To your question, that can be I want to say can be addressed in two parts. In the resolution prior to year end, if you don't know the amount that you're going to distribute, you can do it percentages on the basis of saying that 50% of the interest is going to be split between Sally and Joe Bloggs. The rental income is going to be split equally between Joe Bloggs, Sally Bloggs, Joe Jr. and Sally Jr. And then you could say of the foreign dividend, 10,000 Rand will be distributed to Joe Bloggs Jr. and the balance distributed equally between Sally and Joe. So you're right, you don't need to necessarily state the amount, but you need to state, and you know what, I haven't got it here. I actually didn't upload it or put it onto these documents. And for the love of me, I've got no cooking clue how to actually call it up. I'll have a look quickly when we take a break to see if I can actually get an example of that ratified resolution and add it to the presentation as such. What I wanted to do is say what, I definitely haven't got it in this one. But in that instance, Malcolm, what we do is you've got a resolution that says that in terms of the Income Tax Act, we as trustees are required to exercise our discretion and make distributions and or vestings before year end. For the purpose of this is how we're going to treat it. Then we have that table form, interest, rental, foreign dividends for argument's sake, and then Joe, Sally, Joe Jr. and Sally Jr., and either put in the random amount if we know it's definitive what we're going to pay out to them, or if it's a percentage amount. And then in the resolution, we've got to say that this is the basis on which we're going to determine it once we've actually got the final figures. So the final figures may change in the form, or they will change because we've used percentages, but our percentages won't change. So if we're splitting 50-50 to Sally and Joe, if we've then got 120,000 rands worth of interest, we then split 50-50. I hope that makes sense. Then, Luke, I've answered. I think that's everybody's questions then. So now you've completed the RAV form, you've downloaded your document, you might have received all this information from your trustee and your accountant, because now you can actually start completing, and you as a tax practitioner can actually start completing your tax return and you do your work. Your next document that you then get hold of is this form wizard. And the form wizard then pops up all of those. It's like 2 rows. Once you click on this little button here, it's almost 2 rows of information, starting with your trust details, your whether it's a passive trust, your local amounts, your foreign amounts, capital, non-taxable as such, donations, SARS interest paid. I will be honest, I still battling in trying to understand the comment that they made in connection with it, but we can have a look at it. The venture capital recoupment, and remember your venture capital recoupment is if you have redeemed before the 5-year period. Your big one is your tax credit, then partnership information, and then your participants stroke beneficiaries. Now, this one for me, your participants stroke beneficiaries, is actually it's a crappy one. I don't know what other word to use, and I apologize, in that when you come to complete your information for the UBO, coming back to my example when I was answering somebody's question in connection with if Joe Bloggs is the settlor, a trustee, and a beneficiary, in this instance, you actually have to fill in Joe Bloggs' information 3 times. I want to say, come SARS, what a waste of time, effort. If you're asking for the information as a beneficiary, don't ask for it again then on the UBO. And please don't make us fill in the same thing 3 times. There's enough little tick-down boxes that you can mark. So as I say, there's certain inefficiencies in this form wizard, and hopefully the SARS get the act together for next year, and we're not completing as much. So in this instance, here's the trust details. Now, the little lock buttons are, you obviously they're pre-populated and you can't change them. And these actually come from when you complete your RAV form. So you've got your trust name, the registered name of the trust. Here's your residency. And remember I said to you, you can actually click down and you can actually have, let's say, for instance, I'm trying to think, well, this will be residency for South Africa, but you can actually have a foreign trust. I'm just trying to think if you can have a foreign trust still registered, or a South African trust with an offshore residency, tax residency. You can, but then remember that will trigger a capital gain. Your master's office of where it's registered, your trust registration number, where it was registered, and then the type of trust here, in that it's an inter vivos trust. Now, to answer these questions, just taking a step back and understanding about a trust, you've got an inter vivos trust is one that's created during your lifetime or created by the settlor during his or her lifetime. A testamentary trust is one created on death. And both inter vivos and testamentary trusts can either be vesting and or discretionary, and you can have income vested but discretionary capital, or the other way around, or one of all of the above. So let me go through and just give you an example where you might have each of these situations. Let's say, for instance, we've got an inter vivos trust, and it's set up by Joe Bloggs, but Sally Bloggs is wife number 3, and Joe Jr. and Sally Jr. are actually the kids of wife number 1 and wife number 2, but wife number 1 and wife number 2 are not included as beneficiaries of this trust. Only Joe, Sally Norma Dree, and the 2 kids. Now, Joe wants to make sure that Sally number 3 has got income and she's looked after for the rest of her life. So he vests, in terms of the trust deed, it's a vesting. This vesting here has got nothing to do with the vested and or the distributed. That's an accounting treatment. This has got to do, this vesting and discretionary has everything to do with the nature of the trust. So back to our example, Joe Bloggs sets the trust up. He's got himself and the 2 kids in, and the 2 kids have got capital rights maybe, but no income right. But Sally Norma Dree has got totally vested rights, and whatever amount of income is generated from the trust belongs to Sally, regardless of whether Joe Bloggs is alive or dead. Then in that instance, that trust is a vested trust as far as income's concerned, but Joe Bloggs still wants whoever he's got as his trustees to still exercise their discretion when they give Joe Jr. and Sally Jr. money. Then in that instance, it's a discretionary trust. So you've got a vested income trust because Sally Norma Dree's got a right to that income, regardless of whether you pay it out to her or not. That is her income. And then the kids have got a discretionary. Just taking a step back then in saying, why is this different from your vested and your distributed? And that comes back to that one question that if you've got income in terms of an IT3B, but you haven't physically received it, then you can vest that income on loan account, or ordinarily you can vest monies on loan account without physically paying it over. That is an accounting treatment. It's an accrual rather than a right as such. And when you distribute it, you physically paid the money out. But remember, you can distribute a vested right. So it's a little bit complicated, but in this instance here, the questions that they're asking for in the form of vesting and discretionary has got to do with the terms of your trust deed as opposed to where you actually physically paying monies out on accrual or paying out as such. Then the other one is the standard industry code and then your main source income code. Now, if you then click on, when you go into the little blocky here, you click down and then this thing pops up. Now, in terms of the code, and I also want to say, SARS, if you're out there, wake up on the basis of if you've got a discretionary trust, give us our own section then from that point of view as a, not a discretionary, as a fiduciary industry, give us a section because we might not necessarily all be financial insurance. You might have a combination of financial insurance plus real estate activities because you own what do you call it, a boutique, or you Airbnb in your home. And then you might also have farming enterprises. So you'll need to juggle and have a look at what code fits the what do you call it, the main source. So if at the end of the day, if I had to wake you up in the middle of the night and say, is your trust a farming trust, a trading trust, or a passive investment company, and you had to say, oh, it's passive investment because that's the most amount of income on your assets I've got, then you would then complete in the financial and insurance sector. It's monetary intermediation. And then here the description is this trust funds and other similar financial entities. Now, for me, when you look at the trusts and the funds, I'm thinking unit trusts and the big stuff, not necessarily my small discretionary trust, but for all intents and purposes, for a normal passive investment trust, that maybe it might have investment properties as such and a farm, but its main activity is a share portfolio. That would be the combination. So you'll see here I've said use the code for the majority income by the trust, as you can't put in multiple codes. So for instance, and that this source code is this one here. So once you've then completed or done your standard industry code, depending on what you've chosen as your industry, you would then use for your source codes for the income, either interest of 4201 or property. Other not specified is always a good option, is game farming. Also, I think I've made the mistake before where I've said you can't have a loss. You can't distribute a loss, but you can certainly have a farming loss within your trust. So here's the website. Have a look and see what your source codes are. And that you would then complete in your trust details. I also thought that once you've completed these industry codes and your source code, it's pre-populated from year to year. The answer to that one is it's not. I do go back, and we do go back quickly last year and check to see what code we did, because I would hate to be in a position where we just thought we weren't quite sure and we put everything as other not specified, in that it's dividend income and interest income and REITs and rental and whatever the case is. So we went other not specified, and then this year, because we've now a little bit more pro rata, we've put in interest. Just go back and check what you did last year unless there's been a major change. So that's the source codes. Now, before we take and Stan and Danny, I didn't ask what was the timing. I'm assuming we're going to go to 3 and then have a little bit of a break. What I do want to quickly discuss in this related information form here, because we've been caught short recently a few times with regards to completing the related information. And that is this question here, where it says, is the trust incorporated, established, or formed in the Republic? So yes, if you're still waiting, or if it took you, I want to say 3 years and 2 days to get your letters of authority issued by any of the master's officers, then yes, it's a South African incorporated, established, and formed trust. And then it asks for the place of effective management. Now, 2 things, folks, be hell of a careful. One is when you do your acceptance of trustee form, when you're going to, and that might have been the form, as I said, that you sent 3 years and 2 days ago to the master's office, because that's how long they've taken to issue the LOAs. On that specific acceptance of trustee form, it says, I will advise the master if I become non-resident. So actually, as a trustee, you've got the onus and responsibility to, as soon as you become non-resident, and the question is it non-resident in the form of South African resident temporarily abroad, or is it I've now packed my bags and I'm overseas and I've completed my RAF form? We're essentially doing it on that basis, because if it's just because I'm temporarily abroad and I'm taking a 3-year work there, if you end up with a change of effective management, it's going to trigger a capital gain. Your trust, it's a deemed event, and you will then have a deemed capital gain event. If you've got the position where the majority of your trustees are now abroad. So we got caught not last year, but the year before, when we started to look and put the information together, in that mom pop moved overseas to Ireland. We were still in the process, and we then made the decision that we were going to complete the RAF form. And from a trustee perspective, they had an independent trustee who was running and doing the work. And then when Mum and Pop moved, they asked if I would take over as the independent trustee and replace the current independent trustee. And then when I pointed out to them to say, Mum, Pop are overseas, you two are the ones that are making the decision with regards to managing the bank account. Why? Because you can do it via internet banking. You can still phone up the local portfolio manager and issue instructions and or send WhatsApp or emails. So actually, the fact that the two of you are in Ireland, you're actually running this trust from Ireland, which technically means the day you left, this trust then also changed its place of effective management. And actually, there should be a deemed DGT event then at that date on those assets, because we're now managing from offshore. So then there was a big scramble to say, okay, take off Pop, but add on another local trustee. So from all intents purposes, you've got 2 South African trustees and 1 offshore. And then what happened was the one, I've been put in charge of the bank account. So banking and transactions happens through me from a South African point of view. And the client did ask me as to what indemnities and securities was I going to give him, because I now had access to the trust bank account. And my reply was that he didn't have enough money in his bank account for me to be able to send a card from Philippine Cayman Islands to say, weather's lovely, thanks very much. So it wasn't worth taking anything out of the bank account. But I'm now in charge of the bank account, and the other trustee has got control, and together with our offshore trustee, the two of them have got decision making with regards to investments. And more we're having this, where at the end of the day, and I think somebody asked the question to say, where do we get this information from? We've got to get this information from our trustees, but the trustees actually need to know what's happening or what the implications are from a tax perspective as well, which again, folks, and I know this is not a trust course, when you take on trusteeship, yes, you're taking on a massive amount of risk and responsibility and ownership with regards to making sure that you can tick the box to say, yes, from a fiduciary point of view, my trust is still a South African trust. It's still managed, and my place of effective management is South Africa. My beneficiaries, I might have 2 beneficiaries who have literally gone overseas once they finish varsity or whatever. They've gone overseas. The chances of them coming back are sub-zero at this stage, and therefore they've completed the RAF form. I've got one not trustees, beneficiaries. I hope I said beneficiaries. I've got one beneficiary who's temporarily abroad, but he doesn't like the weather overseas, and he will come back once he's completed, let's say, for instance, a 3-year internship overseas. And then I've got other beneficiaries of South African. As a trustee, you need to be able to understand what that information or how that information affects the poor person who's then being you as the tax practitioner completing that information and submitting it. So as I say, just be careful, and especially, I hate it when somebody says, yeah, but who's ever going to find out? If somebody's asking that question, then actually somebody's found out already. You shouldn't be going down that line. But just to keep everything neat and tidy, if you've got a trustee who is now still on the letters of authority, because that might be the only trustee who's gone offshore, just drop a line to the master's office. They'll only receive it in probably 3 years and 3 days now and acknowledge it. But just know that you've covered your butt. Send that document in to say, I just need to let you know that I'm no longer resident in South Africa. And I would then, as a trustee, say the majority of my trustees are still South African, and the place of effective management for this particular trust is still South African. There was, in fact, in case anybody wants to know, what is the reason that on the master's form, you've got to say that I will advise the master if I, at any point in time, become non-resident. It wasn't because the master's a bit wide awake in the form of understanding place of effective management. It was because if the trustee runs off with the beneficiary's asset and is now sitting in Barbados or Cayman Islands or wherever, and sending that postcard to the beneficiaries that he's supposed to be looking at, the master's got no jurisdiction, or the cost to get that person extradited or to go after them in Barbados and the Cayman Islands is humongous. So therefore, as soon as you've got a non-resident beneficiary, trustee, sorry folks, as soon as you've got a non-resident trustee, the trustees have to provide security to the master that if any trustee mismanages or runs away with the assets, the master can use that bond of security for the beneficiaries. And that in itself is a hell of an expensive exercise. So just be careful, don't get caught short with regards to place of effective management. Then it's that the trust with any connected person hold at least 10% within a CFC. You might find that the trust could now be holding as assets as a result of the loop structures and coming back in. Was the trust engaged in any mining activities or operations? Then here is your important ones. Were any changes made to the trustees in the year of assessment? So that was letters of authority changed. Were any of the beneficiaries changed? Now, this has got nothing to do with, let's go back to my example, where in terms of the trust deed, we've got Joe Bloggs, Sally Bloggs, Joe Jr. and Sally Jr. And in 2023, Joe Bloggs Jr. got monies, and in 2024, Sally Jr. got monies. You didn't change the trustees. Sally Jr. and Joe Jr. were always, beneficiaries. Folks, sorry, they were always beneficiaries. You didn't change the beneficiaries. You might have different disclosures as far as distributions and vestings, but there's been no change to beneficiaries. So as I say, I saw one come across my desk when they asked me to review it the other day, where there was a change of beneficiaries. So I asked them to please give me the trust deed or the approval from the master's office showing that there was a beneficiary change. And then they said, no, we just chose different grandchildren this year from last year for the payment of distributions. It's now another set of grandchildren who are getting school fees. So, but that's not a change in beneficiaries. And then the other one is, were any changes made to the trustee during the year of assessment? If yes, then again, with the beneficiaries, again, you've got to have a look at were any of the rights changed as such. And with the change to beneficiaries, because remember, you might have a vested trust with vested rights, and then you change that. That in itself may or may not trigger either a CGT event or a donation event for the beneficiary, that is. Then it says, did any amounts distributed by the trust or retained in the trust come as a reason of a donation, settlement, or other disposition? That answer, unless it's a testamentary trust, is probably yes in most instances. And then the other one is the trust the beneficiary of another trust, or are other trust beneficiaries of this trust? Now, coming back to that example where I said to you a number of years ago, we changed a whole lot of our trust deeds to take out named beneficiaries and make it quite generic that we didn't have to submit all the FICA. As part of our clause, it did say in our definition of beneficiaries, we say the Mr., Mrs., the children born of this marriage, and we might have a charitable institution or school as such. And then as another clause we've got, any trust established anywhere in the world for any of the beneficiaries who are named above. Now, and the reason for doing that was twofold. One, we were hoping at some point in time, and that's now happened in August 2023, that South African trusts, without having to transfer money into the beneficiary's hands and then the beneficiary takes it up to an offshore trust, now you can have trust to trust distribution. So where we've got that, it's a tick. You can then make a distribution, obviously subject to SARS approval from your South African trust to your offshore trust, and therefore you need that offshore trust as a beneficiary. But if we use, still with my famous Blogs family, now little Joe Blogs has now become a IT specialist, and he's making his own monies, and he set up his own company, and as a result, it makes sense for him to then set up the trust, his own trust, independent of that he's getting now from, or being a beneficiary of his dad's trust. Then you want to be in an instance that when Joe and Sally die, you could want the Joe Blogs trust to be able to distribute to Joe Jr.'s trust. But it might not be formed yet, or that Joe Jr. only forms it when old man Joe dies. So in this instance, I'm answering the question as no, because it's still back to that named beneficiary. So where it still says any trust that's a beneficiary of a trust, unless, like for instance, the resolution that I sent out to a client this morning, because we're doing a trust to trust distribution now overseas, I've now had to name the Jersey trust administered in Mauritius as being a beneficiary of my South African trust. Then in that instance, you would then say yes. I just want to come down. So that's dealing with quite a bit of the information. Let me just have a look at some questions. Where did we get to? Okay, Luke, we answered yours. Les, there's a problem with SARS in registering for the IT3 with trust numbers being different on the records to the trust deed. Oh, I know. Yes. You're going to have to, I don't know if it's then a case of fixing it with the RAF form. As I say, Les, there's a whole lot that still needs to be fixed and done. And I do want to say time's running out, because what have we got? Less than 6 or 7 weeks to go. But I know there's a difference in the registration from a number point of view. I can't. I agree with you. It's a mess. I can't tell you how to rectify that. Then Anonymous, hello. Where a trust has achieved its objects and the trustees have moved overseas after that, but the trust is still registered on e-filing because it cannot be deregistered. So Anonymous, I'm assuming that now you've distributed all the assets. So your process here is you first deregister, then you should deregister your trust. If you're not going to use this trust again, it's met its objectives. All the trust assets have been distributed overseas, then terminated at the master. Then you've got to use that master termination to terminate at SARS. Now, like trying to deregister a company, TRPC take probably about 3 months. SARS at this stage is going anything from 3 months to 3 or 5 years. you're going to have the same problem with this. But unfortunately, you're going to have to still then just submit no returns, no provisional returns, and put it as dormant, deregistered, or wherever you can put. You can't, in fact, it doesn't actually come. Just put it as dormant and just keep trying the process of deregistering the trust. You have to take it off the records, otherwise it's going to be there forever. And somewhere in 10 or 20 years' time, you're going to get a query. What I've told you, if I can tell you on this, what we are doing, and I had another query this morning where we're deregistering a company for a client. The CIPC is easy, and we've dealt with that. Then they wanted a fee note to say, well, what is the cost then for deregistering at SARS? So I've taken a fee note for this year and then for the next 3 years, because more than likely we're going to have to submit for 3 years, because it is taking a while to get deregistrations, both from companies and for trusts, and I want to say individuals from SARS. But you still need to close that loop. Then, Rose, with regards to changes to trustees, if trustees have changed and the letter of story is still not received, can you only select the change if you've received? Correct. So until such time, and that's a massive problem, and I want to say this is a trust question and a legal question as opposed to what we're supposed to be doing here, but you're right. Until such time, Rose, as the master issues the letters of authority, those old trustees are still on the hook. Even if they've sent in their resignation letter to the trustees, to the master, and to the beneficiaries, because technically when you resign, you have to let the trustees, the beneficiaries, and the master know. But the master doesn't issue a new letters of authority, A, that quickly, and B, I can't send in my resignation letter and say, take me off the letters of authority, because what they'll do is they'll send it back to the supposedly the main trustee to say who you replacing, because in terms of the trustee, there's got to be a minimum number of trustees at 3. We see Cheryl's resigning, who are you replacing? And they won't let me off the hook until the person then, the client then finds another third trustee. So it is a massive issue, but yes, you're right. Do not reflect the people and in what you want the change, the new letters of authority to be. It's what your existing one is, and only when the existing one is issued by the master does the new people become the trustees. So then the question is, have there been changes made to the trustees in that year of assessment? If you're still waiting the 3 years and 3 days for the master to actually get the act the act together and issue the LOA, then your answer to that will still be no. So although they've resigned, they're still on those letters of authority. So in this instance, I would say no until you get that new letters of authority. What you can do, and we have done that now in a number of instances in our notes on our financial statements and in our ratifying resolution, is to say 3 years and 3 days ago, we submitted changes to the trustees. So-and-so has resigned, the trustees accept his resignation, and so-and-so was coming in, the trustees accept her letters of appointment, but the new LOA is still pending at the master's office. And then you carry that forward for year 1, 2, until eventually you get it. And I am being nice to the master. It's just extremely frustrating in dealing with them. And maybe they're not quite taking 3 years and 3 days anymore, but flip, you wait a long time. As above, what do you do about effective management? Okay, as in, what do you, Anonymous, that's because you're saying that the people have gone offshore. Okay, so that's a tricky one, because did they go overseas and then you terminated the the trust then as such. So would a capital gains have been triggered before they went to overseas, or while they were overseas and before you deregistered? I don't know. That I want to say is quite specific, but at the end of the day, just look at as to how you manage answering that question, because remember, change in effective management triggers a CGT event. Does disposition to this trust include testamentary trust? George, I think disposition, I'm trying to think, where is the other dispositions to this trust? So I want to say no, and I'll tell you why no, because then you're going to trigger a 7C. If in the question, were amounts distributed by the trust or retained in the trust arisen from a reason of a donation, settlement, or other disposition, other dispositions are usually, yes, and I gave a lecture at the beginning of the year on understanding other dispositions, and it's very, very rarely you come by them, in that there's usually a number of, requirements before you can have the other disposition. If this is for your testamentary trust, George, I would say no, because otherwise it's going to attract a 7C issue. And remember, testamentary trusts don't have a 7C. I think it's rather find where there's been a capital injection. Let's just go back here. I might put it, it's not a donation. I would still put it in here as passive detail, local amounts, foreign amounts. I need to just unpack that. I can't remember the trust deed enough, George, to say to you whether it will go in local amounts, and in local amounts there is a capital section. But no, I certainly wouldn't include it in there, because you're going to open another can of worms. Can only do the correction to the trust registration number via an appointment. Probably, I think. Yeah, I'm not, again, it's an issue. I know it's an issue. I know Physique has been having a look at it from our side. Rose, I'm sorry, I'm not. I would think it's probably via appointment, and the reason via an appointment is because it's like changing somebody's ID number, and then they want to know all and sundry. Beryl, hi Beryl, nice to see you again. How do you see which master the trust was registered at? Okay, that is on your GTB. So if you come back on here, or let me show you on my resolution quickly, and I'm hoping I might have done it. No, I know where I've got it. There we are. If you see there, the registration number, and then, so it will have IT registration number / the year, and then a T. T is essentially Pretoria. G, I think, is Joburg. C is obviously Cape Town. B is Bloemfontein. I actually don't know what Durban's one or Pietermaritzburg one is, but you see it in the last, and on your letters of authority, Beryl, you'll see it in the numeric at the end of your registration number. I just want to see if there was another one. Yeah, but it's in your numeric, it's the alpha in your numeric number at the end of that. Is a local trust permitted to hold overseas assets? So anonymous, yes, it can, but it can only hold it as an asset swap, or so it's not it can invest overseas in your asset swap or your foreign investment portfolios, but it's still rand denominated. So in other words, if you sell those assets, the assets have to come back to South Africa. We haven't got lucky enough yet at the moment to have our South African trust own offshore assets directly where we can keep it offshore, which is why I'm very sad to say that from a South African trust industry, certainly with my clients. If you were sitting anywhere in the world, you would really only have one trust. You wouldn't have a South African trust holding your South African assets and an offshore trust holding your offshore assets, because SARS and Reserve Bank wouldn't allow your local trust to hold assets offshore. So you had to almost undo the whole estate planning exercise of taking the assets out of your local trust, triggering a capital gain, moving them via loan account and or a capital distribution into your beneficiary's hands, and your individual beneficiary then applied for the AIT or the old FIA, then took the funds abroad, then loaned them to the offshore trust if they were doing the offshore trust, or kept them in their own name. So it's still a problem then from that point of view. And I'm wondering, so now we're going to just go into a little bit more detail. And I'm wondering, Stan and Danny, can we just take literally a 5-minute break or longer if anybody needs or wants?
Yeah, I think a break's good.
Awesome.
Yeah.
What, a 10-minute break? Meet back at 15:20. Is that good?
You know how much you need to get through. I'm sure it's fine.
Yeah, I talk kind of a quick, so I'll talk quicker.
Okay.
All right. All right. I will, or in fact, yeah, we'll see you now.
You want to just do a 5-minute one till past?
Yeah, happy with that. 5 minutes or past is great. All right. I'm back. Let's just give everybody the 2 minutes then.
The only other thing, Cheryl, I'm thinking that might help with the sound issues, if we turn your video off and see if that helps.
Oh, sure, but is it still an issue? Oh, folks,
Every
I'm
now and then
sorry.
it comes back. Oh.
How's that?
It sounds better for now. We'll see during.
You know what
it comes and goes. I don't know what it is that's causing it.
It's probably the wind. If you saw the wind here now at the moment, I look out every now and again, and the trees are actually at 45-degree angles. And in fact, I've just got a notice here from somebody to say who was supposed to see me at 4:30, just to say the wind is so violent, I almost got blown off the road. Can we reschedule, please? So I don't know if it's in the Wi-Fi, but where I'm sitting now in St. Francis and on the Crom, the wind is pumping.
Yeah. But it seems to be a lot better now that we turned the video off. But I think in future I must remember to try to say that.
Okay, sorry folks. Yeah, hopefully next time, hopefully I'm back in Joburg area, although I believe the wind there is also crazy. All right.
Yeah.
I'm hoping everybody's back and we can start. Thank you. So now, just coming back to this wizard, you then complete all the information. And as you click down on the passive detail, it asks the information. As you click down into local amounts, it asks the information. I wasn't going to spend time in clicking and putting it all through. You actually need to sit and play about or load it or do it. I do want to say it's a hell of a lot of information, but it actually is in the main user friendly. And George, just coming back to your query, obviously there wasn't enough time to look at your question. Have a look and see for your testamentary trust, in this amount non-taxable, I know there definitely is a capital section. Somewhere I know there is capital somewhere, and that would be your transfer to for a testamentary trust. So if you want to, if you click this, amounts not taxable, I know it's normally dividends or whatever, but give that a bash or go in and have a look at that one, George. Your answer could be in there. So we completed, we got the source codes, we've answered all the other bits and bits of information. Right, now, this, and I've just taken an extract here without doing all the details, but obviously this pops up per income stream. So when you go in and click, and I think there's one here where you click, say you've had remuneration or other income or whatever, it then pops up each of the whatever drop-down boxes that you need. And essentially, the totals per your income stream need to equal the totals per your income statement and the tax computation, which will then in turn equal the sum of the various beneficiary amounts. And then obviously whatever's left is what's then taxed in the hands of the trust. So what I'm trying to say here is, if you've got interest income, rental income, dividend income, and let's say, for instance, what's the interest, dividend, rental, let's just use the three of them. In your for each of those streams, you actually need to almost do a schedule that starts off with interest income received minus direct interest expenses, which, let's say, for instance, might be bank charges or portfolio charges linked specifically to having that account. Less indirect expenses gives you net income that's then available as such for distribution. And then of that, you then determine what's attributed first, then what you're going to distribute, what you're going to vest, and what remains in the trust. A big one, folks, I just want to draw to your attention. I was speaking to a friend in the industry the other day, and she raised or told me about a query that they have in connection with the deductibility of interest. And SARS are coming back to make sure that interest is not just deducted across the board. Interest, it must be in the production of income as such. So just be mindful where you deducting your pro rata expenses. How we normally do it is we would have our interest, our rental, and our dividends, and then you would take each as a percentage over the other. So you would have interest as a percentage of total might be 30%, rent as a percentage of total is 50%, and dividends then is 20%, and then your group expenses, and the group expenses or your pro rata expenses are really just bank charges maybe, and then accounting fee and maybe trustees fees. The other expenses should technically all be able to be allocated to an income stream. Then you determine what's been attributed, what's been distributed and vested. And then, as I say, you end up with what's taxable in the trust, and that's essentially, this balancing or this figure here. And then the sum of the 1, 2, and 3 will essentially be whatever your disclosures are that you've got in this figure. Now, as I say, for me, if we could get SARS to say amounts distributed vested in beneficiaries, because that's then your IT3 Ps, or taxable in terms of section 7, because that's your attribution, it would actually be quite nice to have those in 2 different columns or 2 different rows as such. So you've got some sort of cross-check somewhere to say my distributed and vesting ties in with my IT3 Ps, and then you've got some sort of form and being able to give that information available. This can then actually be itemized and dealt with in that ratifying resolution, where if you wanted to, you could then say back into the table format, this is the total income minus the expenses available for distribution as such. This is what's been attributed, and even if you just put the individual's names for the attribution, the distribution amount and the vested amount. But just make sure there are cross-checks in the source code, because once you put in this information, it also just blocks, it's blocked out and you can't change. And I know you need to balance your income statement, but then you put in whatever amount is distributed vested, and then it then gives you your net sum here. Then this is your trust details, and this is where you complete anything for remuneration, annuities, lump sums, interest, deemed dividends, distributions, etc., farming and other income. Any other income not noted above here. Other income not noted above here might be if you locally had containers or something. What I want to just point out here in connection with annuity, just be very careful, folks, that if you're wearing your hat on as a trustee and you are making a regular amount of, let's say, for instance, our famous 10,000 to Joe Bloggs Jr., and you're paying the 10,000 every month, that 10,000 is actually deemed an annuity. If you don't, in your trustee's resolution, say that you are distributing the interest income to Joe Bloggs for the year, Joe Bloggs Jr., you will pay it in increments of 10,000 a month. It is not an annuity, and at the end of the year, the balance of the interest will be paid. Because if you're paying something out on a regular amount at a regular interval, and remember, a regular interval could also be paid once a year. So my example of the 10,000 when these kids passed matric, and thereafter every year you then give them 10,000, that's a regular amount at a regular interval. That 10,000 doesn't follow the conduit principle. It's then an annuity, and it's then taxed as an annuity in Joe and Sally Bloggs' returns based on that percentage, that 30% is interest, 50% is rental, and 20%, no, sorry, I'm lying. It's taxed 100% as annuity, straight income. Sorry, I'm thinking of something else. It's taxed straight income then. So just be very, very careful if you're paying out a regular amount at a regular interval. And then, as I say, on your income statement, do it per income stream, and then check the deduction of expenses and interest in the production of income. Rose, I'm just going back to where you've asked, and I'm looking at your example here with less attributed amounts. Your attributed amount is what you've got to calculate in doing that income, the loan account schedule. So you've actually got to do a simple amortization schedule, and then that determines how much you've got to attribute back to your funder. And then if you've got to distribute in terms of the funder, you've got to attribute 100,000 back to him. Then in our example, you would then attribute 30% in interest, 50% as rent, and 20% then as dividend. So it's another whole exercise that you've got to do in determining your distributed, when looking at the attributed amount. So I can't give an example in that it requires the calculation, but if at the end of the day, well, let me give you, in fact, I do know of an example. Let me give you one that at the end of the day, Joe Bloggs funds, Sally Bloggs has capitalized the trust with all the other monies, and Joe Bloggs has put in the 5 million for a rental property. That rent from that property is attributed back to Joe as a consequence of him funding on an interest-free basis for the purchase of that property. Therefore, all the rent based on the amortization table is deemed to be Joe's, if that makes sense. So your funding technically follows your asset, and the income from that asset is then attributed back to your beneficiary or back to your funder, but it's limited based on your amortization tables. That's that one. Now, this one here, I just think you then go local amounts, foreign amounts, your capital gain and loss, same you expand. And then your non-taxable amounts. I don't think I brought in non-taxable amounts on here. No. What I do want to show you, and this is where I said to you, we're making that mistake in our income. It says, does the trust want to claim donations made to approved organizations that did not vest in any trust beneficiary? So that's quite an interesting one on the basis of if you've made a donation to or made a vesting to a beneficiary, would any of that donation, sorry, does the trust want to claim donations made to an organization that did not vest in a beneficiary? So in terms of your trust tax rules, you can't distribute a loss. You can't vest a loss. That gets stayed within the trust. But in this instance, you could vest a donation into a beneficiary's hand. So let's say, for instance, you have earned interest income, and in terms of the trust deed, it says 50% of whatever our trust earns in the form of interest, 50% will be paid to the SPCA. Then that you can do one of two things. You can either show the 100,000 minus the 50 section 18A in the trust, or if in terms of the trust deed or the trustees exercising their discretion, they say that all interest income is vested in Sally Bloggs Jr., and because we're paying that section 18A donation out of deemed conduit interest, then Sally will actually get that 18A certificate. all they're trying to do from a SARS perspective here is to make sure that you're not claiming the 18A in the hands of the trust, and then you vesting that income as a consequence of vesting the income, you vesting the donation to Sally, and then she's double claiming it. So you've got a double deduction. Then this one is this new one now at the moment. When I say a new one, in that interest normally is calculated on the earlier of receipt or accrual. Now in this new section 7E, basically SARS are saying that accrual for their interest will only be when it's received by the taxpayer, not when it's accrued to the taxpayer. And then there's an adjustment and a deduction where previously you've paid tax on accrued interest, but SARS hasn't paid it over yet. And then I know that you can then recoup it or claim it back. And then you'll see on the notice of assessment, SARS is also reflecting that interest rolling balance. And the code is this 405Q. So this is basically where you've paid tax over to SARS on money it owed you that it hasn't paid you yet, in the form of interest on refunds. But you pay the tax now, you just apportioning and getting the tax back. Then I just want to, I think that's it in the form. The others, as I say, I'm not going to go through in a huge amount of detail, or I haven't done it in the form of just pulling down these foreign amounts. As you go into each section, you essentially have something like this that then pops up, that then says, this is the income per the income statement, adjust the expenses. There's an interesting one where it says, add expenses incurred as a result of the right of use, just coming back here. So this would be, let's say, for instance, I'm just trying to think, rental. You can't deduct if your beneficiary is using the property as such, you can't, and it's not paying rental, you can't then claim all those expenses. So as you go into each one of these drawdown boxes up at the top here, it then asks very much a similar questions. What was received? What are the deductions? What are your adjustments? And then in one globular figure, what was attributed, what was distributed, and what was vested. Then this form was doing the second part here, where it asks for your participants and beneficiaries. Now, remember I said to you, participants and beneficiaries are essentially your funders and people who have received benefit from the trust. So you could have somebody who has funded the trust, like for instance, a grandfather could have put money in the trust for the benefit of his grandchildren, but he's not a beneficiary, and he wasn't a settlor, but because he's a participant, and that's where it's here, would there be any income that's attributed or vested here? You would put that individual then on participants, because then just quickly, if you come down a little bit, it does ask for beneficial owner details. And this is, folks, where I say we've got the duplications. So coming in here, in this instance, we've just said 1, and this is the information that you need to complete for these participants and beneficiaries. So is taxable, is that person taxable on income or capital gains that have been distributed or vested to beneficiaries? Or is it then in terms of section 7 for your attribution for income, or 68 to 72 of the 8th schedule for your attribution of capital gain? Did they receive a distribution or vesting of non-taxable income? So that would be, for instance, dividend. Is there a distribution or vesting of capital or an asset from the trust? Now remember, you can either distribute an asset or you can distribute the proceeds from the sale of an asset. If you distribute the asset, then in that instance, the capital gain rollover actually rolls to the beneficiary, and you only pay the beneficiary will only pay the capital gain when that asset is sold, but it will be the base cost of the trust. Then this one here had a loan agreement with the trust. Now, don't be a nana on the basis to say, well, if we don't enter into loan agreements, we don't have to disclose it. It's a 7C, it's on your balance sheet, folks. So in that instance, although you might not have a loan agreement, you might certainly just confirm that there is an indebtedness owed to a person, and that, yes, it's a 7C, and also potentially your attribution. Then, did that person make or receive donations or contributions from the trust? The made could be again in the form of making an outright donation or a capital amount, and I don't know, contributions either got to be a loan agreement or a donation and then donations paid, or whether they receive donations. And remember, a trust is exempt from paying donations tax and or contributions that might be in capital. Did they receive distributions from other trusts or foundations? Did they receive a return of contributions made to this trust? So a return of contributions might be, I want to call it almost a repayment of the loan account as such. And then this one here had the right of a use of an asset retained in the trust. Now, I've been asked before, how do you determine the, the fringe benefit, or is there a fringe benefit for a beneficiary using the right to, or having the right to use a vehicle or a property held by the trust? Now, again, years ago, when I sat on the SARS tax committee, when we were doing the transformation from the manual filing system to e-filing, when we asked, and I know Dennis Davis was actually on that committee, and he was actually asked, why did he want to know that information? Because were they going to introduce fringe benefits for beneficiaries? The answer was no. It actually had to do with the deductibility of expenses. Because remember, expenses have to be in the production of income. And if you give somebody the right of use of an asset, but you are not charging them for that right of use, then technically you can't claim the expenses related to that asset. So again, it comes into, if you've got a holiday home in the trust and the beneficiaries all use that holiday home, and all they've got to do is make sure that the ice packs are restocked and the fire stocked for the next person, and they don't have to pay for anything. There's no fringe benefit element attached to it, but the levy and the golf cart and the general maintenance and the upkeep of that house, there is no deduction of those expenses unless it goes on to an Airbnb and you physically receive rental income. It's either received by accrued, then you would prorata a portion of those expenses. So as I say, that is the reason for asking for it. And you'll see back here, they actually say add the expenses incurred. So it's adding back what technically is non-deductible expenses. So it's a bit ambiguous where it says expenses incurred in the right of the use. It's not a fringe benefit. It's actually should be expenses not in the production of income as such. So that's dealing with that last bit. And yeah, the answer to that is if there's a holiday home and the family have got it, and I wouldn't do it that you would then add, make your life easy, folks. If you've got beneficiary receiving benefit, and let's say, for instance, Sally Jr. and Joe Jr. don't physically receive anything, but they go with mom and dad to the holiday home, don't then include them in it, because you're just adding more to the paperwork. Keep it simple from that point of view. Then your beneficiary details, you can either click in to say if it's an individual and a company, and then it draws down the information. What I was surprised, this is actually my trust that I pulled out. And I actually really thought they would have pre-populated this information, because this would have been in the year before. And then I think there's a list of, I want to say it's 20. It's the details of the person and the beneficiaries to whom income, capital, assets were distributed or vested with the highest monetary value. And here they're looking for the information of the person, details, and the details are your tax number, contact details and address, and then the details of the transaction applicable to that person. And the details then of the transaction that I pull it out is then here, was it as a consequence of any one of these? And if you then click on it, then gives you other information or other requests for information. With regards to your beneficiaries and related or your connected parties, persons or beneficiaries, here you can actually click multiple. So if the person is connected in relation to the trust, in that he's a trustee, a founder, or a beneficiary, or is then yes. Is the person a beneficiary of the trust? Probably yes. Is the donor of the trust? Maybe, depending on whether they capitalize the trust. A founder of the trust, in other words, is that Joe Bloggs. Remember, founder and donor, two different concepts. And then here is that person a non-resident, because obviously it's gearing up for our 2025 information. And then, as I say, here's where if you tick the box, whatever these are, then it just opens and moves down and asks for more details. I think I did one or two for you here on the basis of this was if there's any capital income, taxable or non-taxable, distributed. Oh yeah, this was this annuity that I wanted to actually show you here. Any income or capital that's distributed as a deemed annuity must be declared in the section under source code 3611, and then it's taxed as an income. So that comes back to, remember, an annuity is a regular amount at a regular interval. Be hell of a careful of this. This was just using it for section 7 for income, or paragraph 68 to 72 for your capital gains tax, with each of those paragraphs mirroring your section 7. Just as a matter of interest and more of a reminder as such, is to say that if granddad capitalizes the trust and the money is for the benefit of the grandchildren and their minor grandchildren, in this instance, granddad, it's excluded from your section 7s, and there's no attribution back for granddad on income that's earned by the trust. Then this is details of loans granted to the trust, interest rates, it is mandatory, and it could be naught, the loan amount. Now, we're using the loan amount as at the end of the period as such. Inception date, try and go back to see whenever the trust was capitalized. It's a bit difficult if there's like ongoing capitalizations. Again, we've made a practice decision to say it's the date in which the the first amount was done, unless there's been a change in interest rate. So let's say, for instance, Joe Bloggs has got two loans, one of the 5 million for the family home and one of 15 million, of which he's charging interest on it. Then I would do Joe Bloggs as one here with the 0 for the 5 million for the house, and then say that it's not subject to 7C, and then I would do Joe Bloggs with 15 million, and then say, yes, it is subject to 7C. Maturity date, I think that's automatically calculated if you then, oh no, sorry, that's a drawdown calendar. Payment periods, you can also just put 1 or 0. In fact, I don't think you can put 0. It's 1 then on that. Then, George, I think we might have your answer here in the form of capital distribution. So this is non-taxable income distributed. Okay, that was the drawdown one. And then here, details of capital distributions. Here we are. You can either put details of contributions made to the trust, that could go into there, or I would actually rather put it as a capital contribution, because the capital contribution from a deceased estate is capital. So here's just details of amount. Then in connection with your beneficial owners, as I say, unfortunately here, if you've got 3 people as beneficial owners, I just picked on this one being the 3 trustees, in that my kids have got to work for a living and they haven't had any distributions from the trust. I'm part of the ski club, Spending Kids Inheritance. So to that extent, it's just the 3 trustees. And then, and in fact, when I completed it, it actually needs to be completed with 4 here, because I am in fact 5. I'm the founder, a beneficiary, and a trustee, and then I've got 2 independent trustees. So in that instance, my details will then be completed in 5 times. So you'll then complete it as the founder, you'll then do a new one as a trustee, you do a new one as a beneficiary, and a new one, in fact, as a donor. So there's quite a bit of work. Just in connection with Protector. Protector is it's actually not a South African concept, it's offshore, where because you kind of mum pop and your best friend or somebody, passive trustee, or even your accountant or lawyers, not that they're passive, you can't have multiple persons as trustees in overseas. You can actually bring in a protector either during your lifetime or afterwards, and that's a person who basically just looks after to make sure that the offshore trustees know who the beneficiaries are, know what their intentions are. Then, as I said, it's got to be completed multiple times. And then in this instance, as I said, the donor is the funder. Then one question was then asked that somebody said, oh, I'm not taking on trusteeship because then I've got to fill in the details. Yeah, you're right, you've got to fill in the details. But then they said, then they're getting distributions from the trust for their trustees' fees. If it's done in the act of a business as such and a trustee, they're not distributions, folks. They're professional fees. And then whoever's paying it has got to disclose that in their return of income as income. And then here with the particulars, they want to know the initial surname, date of birth, ID number, if the individual is registered for tax in South Africa, yes or no, and then the tax reference number. If they're non-resident, then obviously the passport and the country the passport was issued and passport date, and then the passport place of birth. I'm assuming that place of birth actually got to do that if you've got a passport and not necessarily registered, that if you're registered for South Africa. Otherwise, you might have somebody who's a South African citizen as a consequence of being here forever or applying for citizenship, but they were born in the UK or Portugal or wherever. That needs to then be completed for that specific person. Obviously, an email address and a cell phone number. So as you can see, there's a hell of a lot of information that you need to get about a whole lot of other people that you will not get from your set of financial statements if you as the tax practitioner are given a set of financial statements in order to complete the tax return. You will not be able to do your job. And that is it in connection with the tax return. I just want to come back, George. I think I've answered your question. Nope, I still wouldn't put lump sum benefits received, because the lump sum, I think, then came back if I remember correctly, it dealt with your lump sums in the form of pensions as such. I would still do it as capital. My gut feels certainly on the basis of the amount that's going to ask least amount of questions, George, I would do it as capital. Then Rose, for the holiday home owned by the trust, expenses can be paid, but for tax purposes, they are non-deductible. That's correct. So even though the expenses might relate to looking after the trust asset, correct, they're not deductible, because remember, looking after the trust asset is it's not in the production of income, because your trust asset is not generating income as such. So though you're looking after the asset, and folks in this one, and I know I've been on a soapbox for a long time in connection with this, and that's insurable interest. And that's because I'm sitting here in St. Francis, where we had all the fires a few years back, and I had 3 clients who lost homes in 5 years here. And then there was an issue with the insurance company, because the asset was owned by the trust, but Joe Bloggs, Mr. actually had the insurance on his portfolio because he was at Discovery and he was running and doing his 10,000 steps, and he had the Apple Watch and everything else, and he was getting the benefits. The insurance company asked, well, what was the insurable interest that you had with the trust? And we did have to, in one instance, go the legal route and show that because we were a beneficiary and we were entitled to use the trust asset without paying anything, that was an insurable interest. We've now subsequently gone in, and in all of our trusts where we own a fixed property of which the individual pays the tax as part of their vitality or their the HIPPO or whatever from that point of view, and they get a consolidation of benefits. Send a letter, have the trustees send a letter to the insurance company to say, hi, Joe Bloggs very thankfully is funding the cost of our insurance for this property. And Joe Bloggs has got an insurable interest as a consequence of him being a beneficiary of the property. And then, what are the main mistakes made by tax practitioners in trust taxation, section 7? The main mistake, Anonymous, is actually not advising the individual that they actually have a 7C benefit. And I'll tell you where the big one comes in. Is, let's say, for instance, you've got somebody who's now 75, his days are numbered, he says, I'm now going to donate the money. I've got 10 million, I'm going to donate it to the trust, I'm going to pay my donations tax on it, and that doesn't then give me a 7C issue, and I close the gap as far as my donation is, and the 7C. What they forget is if that 10 million then went into a let's say, for instance, just a pure bond account, on that bond account, because that bond account is as a consequence of that donation, remember, donation, settlement, or other disposition and settlement often refer to soft loans. So though the granddad is now, the 75-year-old oak is now paid the donations tax and thinks that he's no longer got any taxing roles, he actually doesn't have a 7C, but he's still got an attribution role. So that, I would say, is often a common mistake. Why does SARS not populate from the previous year? Yeah, Anonymous, who knows? Flip, it's a waste of time. It should be done hopefully for next year, but yeah, I agree with you. That information should be pre-populated. George, does this make sense? The founder of the trust is the trustee. The donor in it will empower the trustee to register a trust and distribute it part of the estate. I'm not sure I'm following your question entirely. We're running out of time. Can we fold that a sec? George, does it make sense? The founder of the trust is the trustee. The donor in their will empower the trustee. Yeah, you see, that's actually, you've actually got a whole different legal question. George, can we take this offline then on that one? And then Rose, lastly, in trust tax returns, if you do expenses related to property and no income, SARS allows the deduction on assessment. They don't allow it. No, I think, well, technically you should add it back. SARS, I think, are just doing exactly what you are plugging into the return as such. So the onus is on the tax practitioner to make sure, and the trustee to make sure the information is correct. And as I say, a colleague of mine in the industry has just been, they've just been queried with one in the form of interest that was non-deductible. So just because it's going through and just because everybody is doing it, don't do it correctly, because at some point in time, SARS are looking at everything. And Rose, I think you might get a query. Then last one, folks, deadline. 16th of September coming up, fast and furious. That's the opening of our trust filing season. 30th of September is our T filing season for these 3 Ts. January, the 20th is for the filing season closes. So you've got a short time between September and Jan, considering you've got December holidays. 31st of August, now we've got our first 25 provisionals to go in. 30th of September, you've got your top-up provisionals for your year end at the end of February 2024. Remember, do those top-up provisionals so you don't incur interest for your client. And then February 2025, you've got second provisionals. So there's a hell of a lot of work to do. Olympics is finished, rugby season's kind of here. There's a lot to do over the next couple of months. All I can say is hang in there, you've got this. And yeah, just breathe, make it happen. I'm going to come back on. I've lost myself. I don't know now, hold on, how to put my camera back on or put my video. But from a very cold St. Francis, thank you for listening to me. Thank you, Danny and Stan, for the opportunity of being able to present again. I really enjoy it. And yeah, wishing you all the very, very best for the next couple of months with your filing season.
Thank you, Cheryl, again.
Thanks, Cheryl. Very interesting. I trust everybody learned something, at least. There was this young guy, he was trying to impress a girlfriend of his, and he tells her that he's got this big trust and he stands to inherit when his father passes away. Shortly after that, she became his stepmother.
That's a good one.
Anyway, thank you very much. The next seminar is on the 11th of September with Prof. Jackie Aronsa. Thank you today for everybody for joining us. Your certificates will be on their way soon. And Cheryl, as usual, most interesting. I don't know how you managed to talk at 19 to the dozen, but you never lost track of it. We did lose a little bit of your sound, but I think most people, that's okay. I think Danny will distribute the recording, so if you missed anything, you can catch up. And wish everybody a good evening. And as I said, thanks for joining us. Thanks, Danny, and thanks, Cheryl.
Pleasure. Take care, everyone. Go well.
Cheers.
Thank you. Bye.
Bye.
Bye.